I'm Vic Ferguson, and Suzanne and I are going to kind of trade off on topics here. Our general topic here is 501c3 organizations, effective governance, and legal compliance. We are going to kind of break this down into 10 separate subtopics. The organizational test, the operational test, private inurement prohibition, the private benefit doctrine, intermediate sanctions, lobbying and political activities, unrelated business income activities, establishing a for-profit subsidiary, Form 990 filing requirements, and some issues related to the redesign of Form 990. I thought we'd start by kind of going through the actual statute that governs 501c3 organizations so we can kind of focus on where some of these topics come from. So Section 501c3 provides exemption from federal income tax for the following organizations, and this is directly from Section 501c3 of the Internal Revenue Code. So it's corporations, any community chest, fund, or foundation organized and operated exclusively for religious, charitable, scientific, testing for public safety, literary, or educational purposes. No part of the net earnings of which inures to the benefit of any private shareholder or individual, and no substantial part of the activities of which is carrying on propaganda or otherwise attempting to influence legislation, and which does not participate in or intervene in any political campaign on behalf of or in opposition to any candidate for public office. So if we kind of break this down and start back at the beginning of the statute, we see that the corporations, community chest, fund, or foundation organized and operated exclusively for what we call exempt purposes. So that organized and operated are the genesis of the organizational test that we're going to talk about here in a minute, and the operational test we'll also talk about. The next part of the statute goes on to say no part of the net earnings of which inures to the benefit of any private shareholder or individual. That's the prohibition on private inurement that Suzanne's going to talk to you about in a few minutes. And then no substantial part of the activities of which is carrying on propaganda or otherwise attempting to influence legislation. That's the limitation on lobbying by 501c3 organizations that we're going to talk about. And finally, which does not participate in or intervene in any political campaign on behalf of or in opposition to any candidate for public office. That's the prohibition on political activities that 501c3 organizations are subject to. All right, so we'll start here, go through the organizational test. The organizational test requires that the articles of incorporation of a Section 501c organization contain two specific provisions. One, it's got to limit the purposes of the organization to one or more of the exempt purposes. So that's charitable, educational, literary, the purposes we just looked at in the statute. And the articles need to contain a dissolution clause that provides that upon dissolution, the assets of the 501c3 organization will be permanently dedicated to an exempt purpose. So that's generally giving it to another 501c3 organization upon dissolution or giving it to a governmental type entity. So if you don't have those in your articles of incorporation, you could lose your tax exempt status, or if you tried to apply for 501c3 status, the IRS would not approve that. In addition, the articles can't expressly empower a 501c3 organization to do any of the following. One would be engage, otherwise than as an insubstantial part of its activities, in activities which themselves are not in furtherance of one or more exempt purposes. Two would be to devote more than an insubstantial amount of its activities to attempting to influence legislation. And finally, three would be directly or indirectly to participate or intervene in any political campaign on behalf of or in opposition to a candidate for public office. So again, the articles can't expressly empower the organization to do any of those things. Okay, that's it for the organizational test. The second part would be the operational test, which again, the operational test is in 501c3 and says it has to be operated exclusively for exempt purposes. So when Section 501c3 says that a 501c3 has to be operated exclusively for exempt purposes. Well, as with many things in the Internal Revenue Code, they don't mean exactly what they say. We look at the regulations, and the regulations provide that the term exclusively really means primarily. So a 501c3 organization has to primarily engage in activities that further their exempt purposes. So even if you engage in insubstantial activities that aren't necessarily further your exempt purposes, you can still pass the operational test as long as those are insubstantial. But if you do have a substantial non-exempt purpose, as revealed in your activities, that can cause you to lose your 501c3 status. I'm going to turn it over to Suzanne for the private inurement prohibition.
I'm going to talk about private inurement and private benefit, two related concepts, and we'll talk about how they're different as well. First, Vic hinted at, let me catch up the slide there, that no part of an organization's net earnings may inure to the benefit of any private shareholder or individual. And basically, by private shareholder or individual, generally or informally, we refer to those people as insiders. It's any person having a personal and private interest in the activities of the organization. And private inurement, you have to keep in mind almost all the time, because any private inurement is prohibited, and the sole sanction for violation of the private inurement prohibition is loss of C3 status. Now, there can be reasonable transactions between an organization and insiders that we'll get to in a minute. And so who are these insiders? The test is functional, and it looks to the reality of the control. So examples would be officers, directors, or trustees, the creators. In most circumstances, a third party would not be considered an insider or meet the private shareholder individual requirements. And generally, just as background, the IRS does not want these individuals, these insiders, in these positions exploiting the organization's exempt purposes or exempt status for their own personal benefit. So some examples of private inurement. One thing to keep in mind is compensation, and that wouldn't be just salary. So that would be all forms of benefit conferred to the insider. So salary, wages, bonuses, commissions, fringe benefits, deferred compensation, severance payments. Now, the organization can pay reasonable compensation to these insiders, but not excessive compensation. So what is reasonable compensation? Generally, the IRS would look to, and this is in bold on the slide, reasonable and true compensation is only such amount as would ordinarily be paid for like services by like enterprises under like circumstances. So the IRS is looking for the organization to pay what a comparable organization would pay to a person. And cases have looked at the following factors in evaluating whether employees' qualifications, the nature, extent, and scope of the employee's work, size and complexities of the business, comparison of salaries paid with the gross income and the net income, the economic conditions, comparison of salaries with distributions to stockholders. I think that must have been in a non-exempt context. The prevailing rates of compensation for comparable positions and comparable concerns, and the salary policy of the organization as to all employees. So in addition to compensation, another area where you could encounter private inurement would be rent issues. So whether the organization is renting property from an insider or whether the organization is leasing property to the insider. So if the organization is renting, then the rent should be at fair market value. And then as well as if the organization is furnishing property to the insider, that should be at fair market value as well. So in addition to renting situations or compensation, loans are another area where private inurement could be a concern. And again, any loan between an insider and the organization should be reasonable. So if the organization is borrowing, it should pay a reasonable rate of interest. It shouldn't be in excess of the market rate of interest. And then if the organization is lending to the insider, it should first receive security for the loan and then also receive a rate of interest at least the market rate. Now, generally, outside of this context, though, loans made in furtherance of the organization's exempt purposes aren't a problem. So keep in mind the private inurement doctrine applies to insiders, whereas the next doctrine we'll talk about is the private benefit doctrine. And here, similar to the prohibition against private inurement, the sole sanction for violation of the private benefit doctrine is revocation of an organization's exempt status. The private benefit doctrine applies to all kinds of persons and groups, not just to insiders subject to the private inurement prohibition. And private benefit includes any advantage, profit, fruit, privilege, gain, or interest. So basically any of those that would be provided to a person could be considered private benefit. But as you can see, we'll discuss whether an incidental amount of private benefit is permissible, because all organizations could be said to benefit individuals through their activities. So it's the benefit that is more than incidental that you would need to be worried about. And the analysis of whether the private benefit is incidental focuses on whether the private benefit from the single activity is insubstantial relative to the public gain from the same activity. So, for example, most organizations have contracts that benefit private individuals or companies, but this is incidental to the public gain from the activity. For example, like a Habitat for Humanity or a restoration organization may have a contract with, a supplier for materials, but that could be evaluated whether that benefit is incidental and therefore not a problem. So to distinguish between private benefit and private inurement, there are two key differences. One, whereas an incidental amount of private benefit is permissible, any amount of private inurement can jeopardize the organization's C3 status. And then the second issue is the prohibition against private inurement applies only to insiders, whereas anyone can be the recipient of a private benefit. And I mentioned that there's further analysis relating to whether private benefit is incidental. And so there's two aspects to this analysis, a qualitative element and a quantitative element. The qualitative element refers to whether the private benefit is a necessary component of the activity that benefits the public at large. And so to be qualitatively incidental, the exempt organization must be unable to achieve the public benefit without benefiting certain private interests. So, for example, going back to the Habitat for Humanity, that the contract with a supplier is likely necessary to achieve the public interest achieved by that organization's purposes and goals. The other element is the quantitative element, and that basically requires that the private benefit not be substantial after considering the overall public benefit conferred by the activity. So there you have, you have to look at relative to the public benefit, what would be substantial private benefit. So I'm going to turn it over to Vic to talk about the next topic, intermediate sanctions.
Okay, so the intermediate sanctions were the result of Congress looking at the private inurement prohibition and the private benefit doctrine and saying that it's a pretty draconian result to take away 501c3 status from an organization, just for one potential slip-up. So they tried to come up with some sort of a middle ground. So what they did was enact Section 4958 of the code, which we generally call the intermediate sanctions. It generally applies to transactions that would be private inurement, although it does kind of move over into some private benefit transactions. So it's generally dealing with more insiders, which under the 4958 are called disqualified persons. So the intermediate sanctions impose an excise tax or sanction for what are known as excess benefit transactions. An excess benefit transaction has 3 elements under the statute. You've got to have all 3 of these elements in order to have an excess benefit transaction. First, you've got to have an applicable tax-exempt organization. You have to have a disqualified person. And finally, you've got to have a transaction in which an economic benefit is provided by the applicable tax-exempt organization, directly or indirectly, to or for the use of any disqualified person, if the value of the benefit provided exceeds the value of the consideration received for providing the benefit. So again, just like under the private inurement rules, you can pay reasonable compensation to a disqualified person. That's okay. But if reasonable compensation is $75,000, but you're paying that person $100,000, you have an excess benefit transaction. Same thing with a sale. If you're selling an asset to an insider and you sell it for less than fair market value, that's an excess benefit transaction. But actually just selling it for fair market value wouldn't be a problem. So looking at the elements here, what's an applicable tax-exempt organization? Well, it's pretty easy. It's all 501c3 organizations other than private foundations. So generally what we refer to as publicly supported organizations. Now, who is a disqualified person? And this is key because if you don't have a disqualified person, you don't have an excess benefit transaction. So 3 different descriptions here for who can be a disqualified person. First is the most important. It's any person who was at any time during the previous 5 years in a position to exercise substantial influence over the affairs of the applicable tax-exempt organization. So basically, these are the same people that would be insiders, although it's probably a little bit broader. So clearly, it's going to be officers of the organization. It's going to be directors and trustees. But you can even get down to employees that have control over day-to-day activities, like an executive director who may not be on the board or be an officer, but does have substantial control. And even somebody that leaves the organization for 5 years, they're still considered a disqualified person. Second, if family members of a person described under the first paragraph, they are also considered disqualified persons. Family members are spouses of the disqualified person, their ancestors, meaning parents, grandparents, great-grandparents, children, grandchildren, great-grandchildren, and then the spouses of all those people. So a lot of times we're trying to track down family relationships to figure out if we actually have a disqualified person, and you can get tripped up on that occasionally. And then finally, it's what's called a 35% controlled entity, and that's an entity in which the persons described in paragraph 1 or 2 own more than 35% of the beneficial interest. So that could be another corporation, it could be an LLC, it could be a partnership. Probably the simplest example is you have a board member that owns 100% of a corporation and you want to enter into a contract with that organization. But you've got to be careful because that organization itself now becomes a disqualified person by virtue of the board member owning 100% of it. So anytime you're dealing with a disqualified person, you really need to make sure that you're entering into transactions at fair market value or paying reasonable compensation. So some of the same examples that Suzanne brought up earlier for the private inurnment prohibition, loans, rent, compensation are all areas of concern, with compensation being the one the IRS focuses on the most. So what are the sanctions if you violate the intermediate sanctions? They're an excise tax that can be imposed on organization managers, which are officers, directors, and trustees. So the actual board and the officers can get hit with a tax, and on the disqualified person. But interestingly, the actual organization itself doesn't get punished under 4958, whereas under the private inurnment rules, the only punishment is to take away 501c3 status. Under intermediate sanctions, the organization itself won't get hit with anything. So as far as what are the excise tax, well, for the disqualified person, there's a two-tier tax system. Under the first tier, there's a tax of 25% of the amount of the excess benefit. So the example I gave earlier, if reasonable compensation for that disqualified person is $75,000 and they're actually getting paid $100,000, well, the excise tax will be 25% of that difference, so 25% of $25,000. Once that tax gets imposed, if you don't correct it, which means undo that extra $25,000 payment, then you get hit with a tax which is 200% of the amount of the excess benefit. So in my example there, it'd be a $50,000 hit. So that's a pretty good incentive to comply with the intermediate sanctions and undo any excess benefit transaction. Then as far as the organization managers, they're subject, and this would be each of them, would be subject to 10% of the amount of the excess benefit up to a maximum penalty of $10,000 per transaction if they participate in an excess benefit transaction knowing that it's improper, unless their participation was not willful and was due to reasonable cause. So again, that's each officer. So technically every board member and officer could be hit with this if they knew it was an excess benefit transaction when they did it. In order to kind of make sure board members can have some safety, the IRS has come up with what they call the rebuttable presumption of reasonableness, which applies to compensation agreement or compensation arrangements. Following this rebuttable presumption means board members aren't going to be subject to excise taxes if a compensation agreement would ultimately be found to be an excess benefit transaction. We think this is good practice anytime you're dealing with compensation to go through these three conditions to meet the rebuttable presumption of reasonableness. And those three conditions are that the arrangement, compensation arrangement, is approved in advance by an authorized body of the 501c3 organization, which can be the board of directors or committee of the board of directors, and that has to be comprised of individuals who don't have a conflict of interest with respect to the compensation arrangement. So you can't be on the committee that's looking at this if it's your actual own compensation yourself. That would be a clear conflict of interest. Two, and this is really the key thing, is that the authorized body has to obtain and rely upon appropriate data as to comparability prior to making its determination. So what you do is you look at what do similar organizations pay for similar positions. And for organizations with less than $1 million in annual gross receipts, and that's most 501c3 organizations, in order to meet this part of the presumption, you've got to get data from at least 3 comparable entities. So, you know, that can be phoning them and finding out what people are paid, or there are actual organizations out there that gather data from 501c3 organizations from across the country. And you can look at that data. And then 3, and finally, the body has to adequately document the basis for its determination when they're making it. So that's just getting it in the minutes and the rationale for how we arrived at compensation based on looking at the comparisons. Okay, next topic here would be lobbying and political activities. And these two topics come right from the statute that authorize, or the 501c3 of the code, which says that 501c3 organizations aren't prohibited from engaging in lobbying activities, but those activities can constitute no more than an insubstantial part of the organization's overall activities. On the other side, any degree of participation or intervention in a political campaign is strictly prohibited. So focusing on lobbying, the issue is, what is lobbying and how much can you do? Well, there's really two different regimes that you can be tested on to see what's lobbying and how much you can do. The first regime is called what we call the substantial part test, and that's the default regime. So if you've never done anything to make an election, to change the way your lobbying is determined, you're under the substantial part test. The second one is what we call the 501H election or the 501 safe harbor, and some people call it the expenditure test. That's an elective regime. That means you affirmatively make an election to file a form with the IRS that says you want to be tested under the expenditure test of 501c8 or 501H. Okay, under the substantial part test, there's really not a very good definition of what is lobbying other than it's an attempt to influence legislation. So we're always wondering, boy, when are we trying to attempt to influence legislation? So that's one difficulty with the substantial part test. And then what constitutes a substantial part? Well, the IRS has never come out and said. They've never said, if it's how much money you spend, how much time you spend, but it's basically just a facts and circumstances test. After looking at all the cases that have come down, the rule of thumb, and it's pretty conservative, but if you spend less than 5% or less of your time and money on lobbying, you're not going to violate the substantial part test. Anything more than that, you've got to be worried about it, and you may want to go under what's a little bit more generous, the 501H election. But under the substantial part test, if a substantial part of the activities of the organization consists of lobbying, then the organization can lose its 501c3 status. So flipping over now to the 501H election, this gets you out of the substantial part test and allows you to elect to be under a safe harbor rule that provides some pretty precise definitions of what lobbying is and provides certain percentages of how much you can spend, and it only looks at expenditures on lobbying. So time is not an issue. So volunteer time doesn't count under the expenditure rules. I'm going to kind of go through this quick because we're starting to run low on time. But 501H has two different types of lobbying: direct lobbying, which is dealing directly with government officials, and grassroots lobbying, which is dealing with members of the public and encourage them to communicate with public officials. But there are some precise definitions there, so you really kind of stand on, you can figure out exactly when you're lobbying and when you're not. As far as percentages goes, there are charts that, depending on how much you spend in the year, will tell you exactly how much you can spend on lobbying. So I just picked here an example with an organization that spends $100,000 a year can make up to 20% of its expenditures on lobbying. And within that, up to 5% or $5,000 can be on grassroots lobbying. So it's a pretty generous number, and it's a lot more definitive than being under the substantial part test, where you're not really sure whether you're lobbying or how much lobbying you can do. If you violate the percentages, basically you're going to be hit with an excise tax, and the excise tax 25% of the amount that exceeds the safe harbor amount, and you potentially can lose your tax exempt status if you, quote, normally, and that's over a 4-year period, exceed the safe harbor amounts by 150% or more. So, why would you want to make the 501H election? First, there's a precise definition of lobbying. Second, there's a bright line expenditure test is how much you can expend. Really, the only drawback is it's probably a little bit more of a record-keeping issue. You have to keep records a little bit better. Okay, now flipping over to political activities. It's pretty simple. You can't engage in political activities if you're a 501c3 organization. And basically that means you can't get involved in political campaigns on behalf of or in opposition to a candidate for public office. If you do that, you'll lose your 501c3 status, and the IRS does enforce this. So one of the key things is to know when you're dealing with a candidate for public office, and that candidate for public office means an individual who offers himself or is proposed by others as a contestant for an elective public office. And that can be a national, state, or local office. So common political activities that get 501c3s in trouble, one would be contribution to political campaign funds. Just flat out can't do it. Don't ever do that. People look for that and can report you to the IRS. 2 would be making any partisan comments on behalf of the organization. So that's whether oral or written or in publications. You've got to be real careful about that. Now, some people may say, well, what about freedom of speech? Well, the First Amendment certainly does grant that, but you've got freedom of speech in your personal life. But you give up that freedom of speech with respect to political activities when you get tax-exempt status as a 501c3. So if you have board members or officers who are into political activities, they need to make sure when they're speaking or writing that they're conveying their own money, their own thoughts, and they're telling people, that this is my personal activity. I'm not doing this on behalf of the organization I represent. So that's just something to be careful about.
We're going to shift gears and talk about unrelated business income tax. All 501c3 organizations are subject to tax on their income from an unrelated trade or business. And we'll get into what exactly an unrelated trade or business is. And the purpose of the unrelated business income tax rules, it's basically a principle of fairness that exempt organizations shouldn't be able to use their exempt status to eliminate or to be a source of unfair competition with for-profit businesses. So there's 3 criteria for to be taxed under these rules. One is that the activity must constitute a trade or business. So that's defined as an activity which is carried on for the production of income from the sale of goods or performance of services. So it has to be the next requirement is that the activity must be regularly carried on, so conducted with a frequency and continuity similar to comparable commercial activities of non-exempt organizations. And then the final criteria is that the conduct of the activity is not substantially related, other than through the production of funds, to the performance of the organization's exempt purposes. So it really has to be a consistent business activity, not just a one-time thing. In looking at whether the conduct of the activity contributes importantly to the organization's exempt purposes, this requires a substantial causal connection, and a lot of times organizations think that if the proceeds from the activity are used for exempt purposes, then it's okay. That's not the case. It would still be an unrelated business, even if the proceeds from the activity are used for exempt purposes. So an example of an unrelated business might be if a restoration organization does other renovation work for private individuals. If they meet this criteria that it's a trade or business carried on for income from the sale of goods or performance of services, it's regularly carried on, that wouldn't be substantially related to exempt purposes. That would be an example of an unrelated business. There's a couple exceptions. One, it's not an unrelated trade or business if substantially all the work is performed by individuals without payment of compensation. Sometimes we've been asked, like volunteers at concession stands or things like that wouldn't be subject to UBIT. The other exception is the donations exception, which it's not an unrelated trade or business if substantially all the goods sold were donated to the organization. And so if an activity is established as an unrelated business, any income from that activity would be taxed at the general corporate rate. That leads us into establishing a for-profit subsidiary. A lot of 501c3 organizations, they don't like having to deal with the UBIT issues of keeping track of the income, and then also risking that if they engage in an unrelated activity, that their 501c3 status could be jeopardized if they take it so far as to violate the operational test. And so a lot of 501c3 organizations in this situation will put the unrelated business activity in a C corporation, and so the 501c3 organization would wholly own the C corporation. And that's okay because the 501c3 organization can invest its funds or assets in a taxable entity if it receives fair market value in exchange for the equity that it would have in the new C corporation. So the activities of the C corporation would not be attributed to the 501c3 organization for purposes of both the operational test and UBIT. So sometimes you might hear that the C corporation acts as a blocker between the 501c3 parent organization and the subsidiary C corporation. Keep in mind that the 501c3 organization and the blocker C corporation should be completely separate entities. There should be separate corporate formalities, separate books, records, separate meetings. And also keep in mind that, the planning involved with this is that the C corporation, the 501c3 organization is basically conceding that the activities are taxable in that, that the C corporation's activities will be subject to tax. And so if the 501c3 organization is willing to concede that, then they can avoid the compliance burden of reporting and calculating the UBIT, and then also risking violating a test and jeopardizing their 501c3 status. And so after the C corporation has paid tax on its income, then it can return the remaining funds to the tax-exempt organization parent as a dividend, and that wouldn't be taxable. We sometimes get asked whether the blocker entity could be something other than a C corporation. You wouldn't want the subsidiary to be a pass-through entity, whether it's an S corporation or an LLC or a partnership, because the activities of the pass-through entity potentially could be attributed to the exempt organization. So again, you're getting back to that you could be jeopardizing the organization's C3 status with these non-exempt activities, and then also it could generate UBIT for the exempt organization. And then also the blocker, keep in mind that the C corporation could directly invest in pass-through entities. So you would have the parent exempt organization, and then the subsidiary C Corp, and then the C Corp could invest in S Corps, LLCs, or partnerships without jeopardizing the organization's C3 status or generating UBIT. And so this slide shows a chart basically of what we just went through, that the exempt organization would be the parent, and that you could potentially have the C Corp invest in pass-through entities. We're going to shift gears a little bit and talk about the Form 990 and what the filing requirements are, as well as the recently redesigned Form 90, some components of that. As many of you may know, that Form 990 is the annual return required by the IRS of nonprofit corporations. It has to be filed by the 15th day of the 5th month after the close of the organization's fiscal year. So May 15th if you have a December 31st fiscal year, or December 15th if you have a July 31st fiscal year end. And there's 3 alternative filing requirements based on the assets, level of assets and receipts. The most basic is the Form 990N, and that's for organizations with gross receipts less than $50,000. The intermediate is the 990EZ. That's for organizations with gross receipts less than $200,000 and gross assets less than $500,000. And then finally, you have the Form 990, organizations with gross receipts more than $200,000 or gross assets more than $500,000. Some of you may be familiar with the 990N. It's pretty basic, filed online, sometimes referred to as the e-postcard, where you just basically provide some basic information to the IRS. You also may have seen in the media, there's been some, if you fail to file the 990N for 3 consecutive years, there's no monetary penalty, but tax-exempt status is automatically revoked. On the 990EZ, that form requires additional organizational information regarding officers, finances, programs, and there is a monetary penalty on that filing, which is $20 per day, not to exceed the lesser of $10,000 or 5% of the organization's gross receipts for that year. There's also a penalty on responsible persons. So if the IRS sends a notice to a person responsible for an organization and they give a due date of when the filing is required and the person and organization fail to comply with that due date, a penalty of $10 per day is assessed, not to exceed $5,000. And then similar to the 990N, if you fail to file the 990EZ for 3 consecutive years, tax-exempt status is automatically revoked. And then lastly, the 990, again for organizations for larger organizations with receipts more than $200,000 or assets more than $500,000. Vic will get into some of the disclosures required. The late penalty is the same, $20 per day, except that for organizations with receipts exceeding $1 million. So for the largest charitable organizations, the penalty is increased to $100 per day, not to exceed $50,000. And then the same penalty on responsible person and failure to file penalty applies as the EZ.
Okay, some of the redesigned 990 issues, and we'll do this quickly because I know we want to leave some time for questions if anybody has them. But the 990 was substantially redesigned a few years ago now, and it probably doubled in size. And the IRS took it upon itself to ask a lot of questions that some would argue it has no business asking. You know, an example, and there's numerous examples like this, are the 990 asks whether the organization has adopted a conflict of interest policy. Well, there's absolutely no legal authority that says you have to have a conflict of interest policy. What the IRS is really trying to do is to, I would call it, guilt you into adopting a conflict of interest policy because you don't want to answer that question no. Because the fear is, boy, if I answer questions like that no, the IRS is going to audit me. And we really have no idea what audit risk is from answering these questions no. Most people think that a lot of these questions are just what they call data mining. It would be the IRS trying to gather information so it can decide how it's going to deploy its resources in the future. So there actually could be some truth to answering some of these questions no could trigger an audit someday, but we really don't know the answer to that for sure. So basically what these questions encourage, and I'll say that encourage in quotes, organizations to implement certain practices and policies. And some of the practices here would be a mission statement, basically just a simple description of why the organization exists, what it's trying to accomplish. Second would be a process for review of the 990. The question on the 990 is, do you give the 990 to your voting members? So it can be a simple, simple process is to say, the board meeting before we file the 990, our accountant comes in and goes through it with the board. Three, and I talked about this before, was a rebuttable presumption for compensation. There are numerous questions on the 990 about compensation. If you follow that rebuttable presumption, you can answer all those questions in the affirmative. Four would be, they ask if meetings or minutes of meetings are taken. That's just pretty good practice anyway. So all meetings you should take minutes. Fifth practice would be whether you have an audit committee. There's a question about that. It kind of depends on how big your organization is, but for large organizations, it's probably good to have an audit committee that has oversight for audited financial statements. Sixth one, and some of you may have seen these, is a questionnaire that is put out annually to officers and directors about relationships to one another, transactions with the organization. Most accountants that prepare Form 990s have a questionnaire like this that they'll send out, and that's a pretty good practice. The policies the IRS has encouraged, one is the conflict of interest policy. That's pretty self-explanatory. Two is the whistleblower policy. 501c3s are subject to the Sarbanes-Oxley Act. A lot of people think that's just public companies. So having a policy about what someone should do if they think someone within the organization is violating the law is encouraged by the IRS. Same as a document retention and destruction policy. That's another Sarbanes-Oxley Act. So if you're under some sort of an investigation by authorities, you don't want to be destroying documents, and it's good to have a written policy about that. Fourth policy is a policy on joint ventures. That so if you ever enter into an LLC with a for-profit, you have a policy that ensures that you'll look out for your tax-exempt status. Some other policies, an expense reimbursement policy, another good practice. And that can be as simple as if someone wants to be reimbursed, that they have to have a written receipt. The IRS doesn't want people trying to skim money from the organization. And if you're an organization that issues bonds, having a policy regarding compliance with the tax-exempt bonds is important. Other policies you might want to consider, a gift acceptance policy. Certain assets you may or may not want. If somebody tries to give you some real estate, you may want to have a policy that says you're going to do a phase 1 environmental assessment to make sure that you're not taking on something that could really cost you more than it will help you. Or becoming an owner of an LLC that could produce UBIT issues that Suzanne talked about. And finally, a code of ethics, and maybe even an investment policy that sets forth what kind of investments are acceptable to the organization. So that ends it for us.
Well, thank you, Vic and Suzanne. Heritage Ohio would definitely like to thank both of you for agreeing to do this today and sharing your information with us. Heritage Ohio would also like to thank Scott Zients, who helped set this up. He's a partner with Suzanne and Vic here at Vorys, Seymour, and Pease. And right now, if you could, you can start typing in your questions. Heritage Ohio would just like to thank all of you today for attending. If you enjoyed today's webinar, please think about becoming a member of Heritage Ohio. You can learn more at our website, which is www.heritageohio.org. We're going to get started with the questions we already have from earlier. So we're just going to open it up. And please, if you have any questions, just send them to me, and we'll get them all answered today. The first question is from Andrew. Andrew would like to know, when we're talking about the lobbying section, the politics section, he has an example of Citizens United. And he wants to know, what about organizations that benefit nonprofits and for-profit entities in that situation?
You understand that? I'm trying to figure, I mean, you're either lobbying or you're not lobbying, so it doesn't really matter. They're not going to, the IRS is not going to, from a lobbying perspective, is not going to worry about whether you're lobbying for an exempt organization or a non-exempt organization. If you're lobbying for a non-exempt organization, you've got issues on the operational test side of things and on the private benefit side of things. So you potentially could lose your tax-exempt status for doing that unless you can tie that into how that is promoting the exempt purposes of the 501c3 organization that's actually doing the lobbying.
And my only thought that may not be directly addressing the question was just that, we talked in the context of 501c3 organizations. If you wanted an organization that could lobby more, you could create a 501c4, or there's other options if you wanted to do more lobbying, and you weren't concerned more lobbying than you could conduct and still be an exempt organization.
Okay, Andrew, I hope that answers it for you. If you have any clarifying comments about your question, just please send them in. The next question is, well, actually two questions are from Joyce. The first one is advertising in a nonprofit newsletter considered taxable? And should the display advertisement be laid out as a sponsorship message instead?
I think that could be considered a taxable. I'm trying to think of whether we've been asked that specific question before.
There are, okay. Advertising is a dicey issue in the UBIC context. If it's truly advertising, and you're putting in there in your newsletter or some publication that so-and-so has the best pizza in town and it's really promoting their product, that's advertising, and that's clearly an unrelated trade or business if it's regularly carried on. Certainly not related to your exempt status. There are what are called qualified sponsorship payments, which is something, I think it's in section 513I. And that allows you to, I'm trying to think of the language in the statute, but basically it allows you to acknowledge someone that has made a contribution rather than advertise. So if my law firm gave money to your organization, you could put in your publication our name, Vorys, Seymour, and Pease. I think you can even put our address and phone number, but you can't say, for all your legal needs, go see Vorys, Seymour, and Pease. If you just acknowledge the contribution, that qualifies as a qualified sponsorship payment. But anything more than that is potentially subject to UBIT. Now, UBIT's always not bad. Some UBIT, if you don't have too much, you just have to pay tax. But you get money, you get to keep the net after-tax income.
And Joyce's second question was, when a 501c3 is soliciting sponsorships for an event, what can they do when a candidate's campaign wants to sponsor an event so that their names will be all over a 501c3 event?
Can't do it.
Decline.
That's simple.
Okay. Christina has a question on, she's with a 501c6 Chamber of Commerce, and they're considering going to a 501c3 foundation arm of that organization. Is that possible to do? And would you recommend trying to change from a C6 to a C3 instead?
Wow, that's a good question. I've done it. I think I've done it, changed from a C6 to a C3 before. That was for an organization that really ended up being much more educational. But you'll often see 501c6 organizations that have a subsidiary. Basically, the 501c6 would be the sole member of a 501c3. And as the sole member of the 501c3, the 501c6 organization would appoint the board of directors of the 501c3. What you do then is operate the two separately, and they work really well. And we have a lot of clients that have this set up. So if somebody wants to make a charitable type contribution for an educational purpose, you have that money go into the 501c3 that does your educational type activities that a lot of 501c6s do anyway. But the benefit there is when a person contributes to the C3, they get a charitable deduction. Then you can keep doing your 501c6, trade association, chamber of commerce type activities in the C6. So it's very common to see a C6 with a subsidiary 501c3.
Did she ask about a C4 too? I mean,
No, not the C4, just the C6. Okay, Christopher has two questions here. First is, when there is a name change to an existing 501c3, is the Ohio Secretary of State notified first, and then the certified Ohio change of name form subsequently sent to the IRS?
You have to change it with the Secretary of State first. That's the name change form, so that's done as an amendment to your Articles of Incorporation. Then there's a couple different ways you can notify the IRS. I think you can just do it on your next 990 that you file, indicating the name change, or I think there's a way to...
There's a certain address that you can, an IRS address that you can contact them, provide the name change and proof that your articles have been changed. I think you would have to either get that from the IRS website or call, we usually call the tax-exempt IRS number.
Not surprisingly, the IRS, when you have name changes, sometimes gets them confused. So we've had to deal with that before.
And Christopher's second question is, how important is it to hire an independent accountant for completing a 990 form as opposed to self-completing it?
Well, it depends how good you are at completing them yourself, I guess. It's certainly cheaper to do it yourself. I think for smaller organizations, doing it yourself is not a bad way to go if you think you have at least some level of confidence doing it. I think as the organization gets bigger, it's important to have an independent person do it. Just kind of a check and balance to make sure nothing strange is going on, because you really don't want anyone that's in charge of the money preparing the 990s, because that's one of the ways you can find out if someone is skimming off the top.
And back to Andrew's question about Citizens United. He just sent a little brief synopsis of what they do. Citizens United treats or acts for private for-profit corporations as individuals for free speech. Nonprofits are not treated this way because it operates in the public trust. That's just what he's saying about it.
Okay, so this is a 501c3 that promotes free speech?
I believe so, yes.
Okay. So I think that was the question about lobbying?
Yes.
Okay, if they're lobbying to promote free speech, that's furthering their exempt purposes. So my concern about doing it for a for-profit is not as great, because that actually does promote their exempt purposes. But lobbying, if you're lobbying for a for-profit or you're lobbying for a non-profit or a 501c3 or a 501c6, it doesn't matter. There's going to be certain limitations on your lobbying. You can either go under the substantial part test that we talked about or make the 501h election. I would suggest, it sounds like they probably do a fair amount of lobbying. If you do a fair amount of lobbying, typically always going to make the 501h election unless you're a huge organization, because the 501h does have an overall cap on how much lobbying, how much money you can spend on lobbying, and that's $1 million in a year. So there are certainly organizations that spend more than $1 million, and they'd rather just be under the substantial part test and take their chances.
And Jan has 3 questions, all put together for you. So I'll try to break these apart for you. In Conshohocken, we are in the process of filling out the 1023 form application for a 501c3 status. Is there a template we can use that would show us the way other Main Street programs have answered these questions? Is the first question.
I would say there's no template, although the IRS has maybe said that they are going to come out with some sort of help format that you could call maybe. I haven't heard anything finalized on that. And then secondly, you could possibly, the 1023 is a public record. You could ask another organization for theirs, but we've often wanted to, because part of our practice is completing those 1023s and getting exempt status. We'd like to see other organizations 1023 sometimes too, but aren't usually able to come across them.
And the second question is, for a Main Street style program, is a 501c3, is for a Main Street style program a 501c3 necessary for them, which typically is a nonprofit entity, but can be a 501c6 as well.
Well, Devin, you gave me about a 30-second overview of what the Main Street program is. Well, I guess it boils down to what exactly are you going to do. And 501c6 organizations promote business interests. So if you're going to do lots of economic development type activities, I think 501c6 is the only way to go. Mm-hmm. There is starting to be, the IRS is accepting that some forms of economic development can be charitable, and you can do them in a 501c3. Pretty limited circumstances. It's really got to be educational type stuff, or if you're dealing with a very poor folks, I guess is, I don't know if that's an appropriate word, but if you're dealing with people that are poor, you can do some economic development, or if you're dealing with what's called blighted area, you can sometimes do some economic development in a 501c3.
And the final question is, along these same lines, are there examples of various policies such as code of ethics, conflict of interest policies that you can find somewhere?
Yeah, I'm sure if you go on the internet, you can find anything. Whether they're any good, I don't know. I mean, we certainly, attorneys draft these policies for organizations, and sometimes we have just standard policies we use, and other times we have people want very customized. I'd be a little hesitant just to rely on something you get off the internet, but in some cases, it's better to have a policy than not. In other cases, if you have a really bad policy or you don't follow it at all, it's worse to have the policy.
That's what I was just going to add. Make sure that once you have the policy, you understand and comply with it.
Okay, and back to the Citizens United. He has clarified for us again, just that I misunderstood him earlier when he was talking. It's actually the Citizens United versus Federal Election Commission case before the Supreme Court last year, which he's referring to. So he's wondering how that case is influencing what nonprofits can do, if there's been any influencing that's happened.
It hasn't on our end. I know I'm familiar with that case a little bit. We have a whole government relations team here that deals with that on a daily basis. So I'd have to defer to them before I really gave an informed answer.
Well, yeah, and in terms of for-profit corporations, making political contributions, again, like Vic said, we would just, that's not necessarily our specialty. We would focus on the nonprofit area, but we haven't seen a direct, the members of the government relations team haven't, contacted us, or we haven't otherwise heard about an influence there.
Okay, the final question. Maureen is asking, can you discuss the ways to house a farmer's market within a 501c3 organization so that it does not compromise its nonprofit status? Or if that's possible.
So, I mean, I've not seen one. I'd have to give that some thought. I mean, that's a tough one. Sometimes you get creative. You can think of ways to do that, and it doesn't. I'm thinking of one I've heard about. So if we're like talking about, and I'm just thinking off the top of my head here, so don't go and rely on this. If we're talking about like all organic foods that are grown under certain conditions, and that somehow promotes the environment, or you can say that it promotes the health of individuals. You might have a tie in there. Yeah,
or maybe like economic development for local farmers. We'd have to brainstorm for potential.
Yeah, you'd really have to look at the facts and see, how can I tie this into health, improving something in the community. Yeah, it really would be very factually driven, just with what I'm not going to say you couldn't do it, but it has to be the right facts to be able to do it.
Maybe the right IRS agent.
And maybe the right IRS agent.
Well, that concludes today's webinar. Join us for our next webinar on August 3rd. And thank you again to Vic and Suzanne for doing this today. It was a great webinar, and we'd like to also thank Vorys, Seymour, and Pease just for allowing us to do this today. And thank you, and have a good day.